Yeah, thanks, Tim, and thanks to ShareCafe for the opportunity to talk to quite a large group and give them an update and some background on Regis and where we're going. So I just draw everybody's attention to the cautionary statement, which is pretty standard. Given it's 10 minutes, I'll move through this fairly quickly and try and stop on some of the key points. This slide gives a decent background. You can see we've got quite a distribution of our shareholders globally between Australia, US and Europe. Our market cap at the moment sitting at a bit over 2.6 bill. Our board, a key point here, we've got quite I think a depth of experience sitting on the board. We've got a banker or an ex-banker, although sometimes that's worth a bit of criticism, but it's great experience to have on there. We've got a very experienced geologist in Linda. Fiona Morgan is an engineer and runs an engineering company, but she's very experienced in the construction and engineering background. Steve Scudamore, of course, with a great accounting and auditing and commercial background, and Russell Barwick, people would be aware in history, has been MD of Newcrest and COO of Goldcorp over the years. So I think we've got a great board that's got a good understanding of the commodity, but also of the mining game. Next slide, thanks. Look, I was going to just touch on the COVID response. It's, you know, you almost feel like you're being done to death on it, literally and figuratively, but it is still a very real risk. We've over the last few months since our first initial incident that we had with a potential COVID, which was in January, we have instigated a multiple number of control elements. And we've actually been backing off and following the guidance from the state. All our operations, of course, are here in Western Australia. But we still have them. We're part of these major FIFO detect, which is to date, it's had about 12,500 samples of people working in the FIFO industry. I was just looking at the stats this morning. Of the 12,500 people sampled, one I think has been positive. The rest have been clear. We still have social distancing. We've stopped the social distancing on our flights. We've got a lot of, we still have social distancing on the mine side and the food prep, but we're certainly easing those restrictions, but still trying to keep the workforce and all our people very attuned to the background risk that sits with a potential outbreak. Next slide, thanks. So what are we? I mentioned our size. We've got 3 mines that's sitting in WA at on the Duketon Greenstone Belt. We've got Moolart Well, mill capacity 2.5 million tonnes, Garden Well 5 million tonnes, and Rosemont Mill at 2.5 million. So across our operations, we've got about 10 million tonnes of milling capacity. We have reserves of 4 million ounces this last year when we put our results out. We've got strong growth production, which is really what I want to talk about. We have been a very strong dividend payer and nearly $450 million paid in dividends since 2013. Strong cash position at the end of March at just under 170 million in cash and bullion, no debt and internal growth. Next slide, thanks. We have commenced transparency. Last year was our inaugural sustainability and ESG reporting. We have it available there for people if they'd like to go through it. And of course, if anybody has any questions, we're always happy to take a call and help to fill in the gaps where people may have them. Next slide, thanks. I've mentioned that on one of the earlier slides, we're a low cost producer. This is showing where we sit on an all-in sustaining cost US dollar basis, both with Australian producers, pardon me, but also our international peers. You can see we're sitting in the bottom quartile. A great position to be in, and something that we work and fight very hard with our business to make sure we're staying in control of our costs. Next slide, thanks. Look, our growth sits internally. We take a view that our potential underground operations add to our existing production profile. Our guidance in the financial year just finished was 340 to 370,000 ounces of gold. I can't make any comment. Of course, we're in the blackout period in terms of notifying people of what our performance has been. But I can talk about what our future is looking like. And our growth predominantly comes from underground. We're mill constrained, so we look to drive a high grade through the mills with these great little underground mines that we're starting to identify and develop. We do have open pit opportunities at Duketon. McPhillamys is the major step change project that we've got, and exploration is going to give us life. So I'll put a bit more context around that. Next slide, thanks. This is what our production profile looks like. You can see that 2019-20, which is reasonably flat relative to the prior year or two. But from here, we're on a growth pursuing from Duketon alone up to circa 400,000 ounces. And with that slightly darkened zone, you can see that contribution. The thing that allows us to grow is the underground. Next slide, thanks. At ROSEMONT underground, we started about this. We have been producing from there over the last, well, probably the last 6 months at least. But now we're into stoping, and that's got great. We'll see the production contribution from the ROSEMONT underground start to become much more significant in this coming year. It's only really started to hit its, get close to its straps in this last couple of months. The great opportunity at ROSEMONT, and ROSEMONT sits with about 4 years of mine life. We'll be pulling about 500,000 tonnes a year out of there. Its reserves grades are sitting at around about 6 grams a tonne. But it's got great, it's a typical underground Australian mine. It's probably got 3 years or so, but we want it, and we think it'll be something that's got 3 years of mine life and will do for the next 10 years. And to prove that, we're doing some very deep drilling underneath in those areas that you can identify in the box. And that we see is going to be something that gives us extending our lifetime, our life of production from ROSEMONT. And very exciting. You can see we've had one hole already very deep below the straggly end of our ore body actually, and we still hit 0.3 of a metre at 44 grams a tonne. So we see production coming out of there, and we see great potential for future growth from ROSEMONT underground. Thanks. The next slide is looking at what we're hoping to be the next cab off the rank. This is sitting underneath Garden Well. It's similar to ROSEMONT. The grades aren't quite so good, but it's the beauty in this is it's much thicker. It's much higher. You can see it's got up to 10 metres in true thickness. This has got great potential. We're working our way through the DFS at the moment, and we're hoping that this can basically tag on the back in much the same way that ROSEMONT underground has, and allow us to continue on our growth production profile up to and beyond 400,000 ounces per annum out of Duketon. Next slide, thanks. So the next piece that sits on the end of after 21-22 is McPhillamys. Next slide, thanks. McPhillamys is a 2 million ounce deposit that sits in New South Wales. It's a great 10-year mine life. We're in the process of, we put in our development application. It's got the potential, our intention is to have it to produce at circa 190,000 ounces per month, per annum. And we're running through the approval process at the moment. We see that we're anticipating that we'll reply to submissions, which is part of the process, in about 2 months' time. That will then go to the Department of Planning, where we're anticipating a positive support there. Subsequent to that, it'll go to what's called the Independent Planning Commission, the IPC, for approval. And we're anticipating at the moment, we're being guided that process should occur in the first half of next year, potentially in the March quarter. So we can conceivably see that this will certainly be a production on that time frame. We see about 14 months to construct. So if we start building this thing in the middle of next year, we can be producing towards the back end of calendar year FY22. And as I said, that'll be producing at a rate of around about 190,000 ounces per annum. And it's got a 10-year mine life. And its costs circa around about 1,100, lifetime average around about $1,150 per ounce. So a great little addition. Next slide, thanks. A great little addition that you can see in that area as we look beyond FY22, we can see Duketon hitting circa 400,000, and then we've got the potential for McPhillamys to add another 150 to 200,000 ounces per annum on the back of that, which is really the growth profile that we are chasing. Next slide, thanks. The last piece that we really want to be able to do is to add to our reserves at Duketon. We've got a mine life there, as I mentioned. We've probably got reserves of about 2 million ounces. We haven't been doing over the last few years a lot of exploration, and we've now swung the pendulum back. We've increased our exploration greenfields expenditure up to $31 million in the year just finished, and we'll be following something circa to that level this coming year. Now we've got some great potential sitting on the Western Belt, and we have commenced the very preliminary stages. We just picked up a lot of ground. We originally only held about 1,000 square kilometres of ground. We've had that for many years, but in September, October last year, we purchased another 2,000 square kilometres. We now own around about 98% of that belt. Well, we own it from an exploration point of view, a ground holding point of view. And there's been very little well-structured exploration done on the Western Belt there, the Risdon Well, Western Sediments. We understand the geology, and our exploration team are really have been very excited to get hold of that ground, and we're looking for some great future there. Next slide, thanks. So, you know, as I said, the underground gives us the growth in production from Duketon. The new project at McPhillamys gives us a massive step change in production, potential step change in production once it's approved and constructed, which we see over the next 2 or 3 years. And then finally, next slide, thanks. The exploration will give us the extended life beyond the current 5 or 5.5 years that we currently see at Duketon. So in a very quick burst of 10 minutes, hopefully I've given you an explanation of how ROSEMONT sees its, Regis sees its future. Its growth in production comes from underground at Duketon. Its step change in production will come from McPhillamys, and its extension of life will come from the significant amount of highly prospective ground that we picked up around our own mills. And we're looking for exciting information to come out of that over the next year or so. Thanks, Tim. Back to you.
Yeah, thanks, Jim. Thanks for your time. A great Australian success story in the gold sector. Got a question around your hedging policy. How do you hedge things moving forward?
So we've had a long-standing hedge book that's been in place. Currently, at last disclosure, we had around about 418,000 ounces at an average hedge of about 1,620 Aussie dollars an ounce. Now, our hedge book is something that's a little bit unique. They're spot deferred. They don't have a set time tenor on them, and we are able to push them down the track or sell into them as we see. It's actually it's been sitting there for many years. We've made a strategic decision that we'll start selling that down, because it is something that sits in the background and you've got to deal with it. It's not so much a policy, but our clearly stated position is we're selling at least 10,000 ounces per quarter into the lowest value of those ounces. And we've also indicated that we'll probably look to speed that up so that we can start to get rid of those hedgings at a greater rate. In terms of further hedging, our position at the moment is if we don't need to do it, we won't do it, and we certainly don't see the need at this point. So all we're doing at the moment is working hard to get the balance right between selling into that hedge book and also enjoying the high price. I think in the last March quarter, we put the numbers out. We indicated that effectively the cost of selling into that hedge book at the rate we described has cost us around about 5% of the, on average, over that period was about 5% of the average gold price.
Yeah, a good answer. And there's 170 odd million on the balance sheet there. Is the plan to return that? You have paid dividends. Is the plan to return that as dividends to shareholders and/or push for further growth?
Yeah, look, it's a good question. We have shareholders that are interested in one end of the spectrum or the other, and both. In the end, we've got to look to see what's right for the long-term benefits of our business, remembering that the fundamental reason that we're here is to make money and return that to our shareholders. So we've had a strong dividend return policy in the past. That certainly is something that the board discusses every time we meet. We talk about how we're travelling and how that's looking to be able to continue with that. Of course, we also have to take that into the context of capital demand that's upcoming and what the needs might be. And clearly with McPhillamys, its original estimate was $215 million in CapEx for the plant and associated infrastructure. And as we've guided quite clearly in our releases, we anticipate that was 215 million plus or minus 25%. We're anticipating now, and that was probably about 2 or 3 years ago, that estimate was made, given our understanding of the increased requirements from capital on installation and the difference between building something in WA and New South Wales, the cost of that plant has increased. And as we've said previously, we anticipate that the bottom end of the new capital range is the top end of the old range. So the top end of the old range was about 270 million. So, you know, the maths aren't particularly hard to figure out, that we're talking a number that's sort of probably got, you know, quite the bottom end would be 270 million, and it's obviously going to be sitting above that. Now, what that means is that there's going to be some reasonably significant demands on our capital. So we have to take that into account in this multiple formula of what's the revenue like. I mean, prices are great at the moment, and so our cash generating capacity is quite strong. We've got a hedge book. We've got a significant piece of capital coming up. In McPhillamys, we've also got potentially other capital demands associated with another move underground if Garden Well comes off. So we take all of those and balance them up and look to see how can we meet our overall objectives of making money and returning it in amongst those near-term demands.